In this particular video, I will take you through some quiz questions related to Alternative Investment Fund Manager certification, also known as 19C certification of NISM. I am going to discuss with you questions related to Chapter 8, which is Alternative Investment Fund Structuring. And you will find 10 quiz questions as we go ahead with mostly with 4 options, in some cases true and false also. These questions are more to do with what kind of structures these funds can acquire and what are the different types of buyouts that we may have in the market, right? So there are different types of buyouts which is opted for by players such as venture capital funds, private equity and all that. So broadly 2 areas covered. So let us start with the first question. The first question is, which of the following is not a possible structure for AIFs in India? So, alternative investment funds can be legally created in different structures, right? They can have structures such as limited liability structure, trust structure, company structure. But in India, as per the law, there is no provision for partnership structure. Now, let us understand the difference between limited liability partnership and partnership. Limited liability partnership ensures that the liabilities of the partners are limited. And the concept of pooling in alternative investment fund also is linked to that. When you create a pool of funds, the loss that uh, will be incurred by the investors will be limited to the extent of investment that they have made. So partnership is not possible because partnership may have an unlimited loss, but limited liability partnership is possible. So the answer is A. The question 2 is, which of the following options represents a potential benefit feature of pooling of funds? So when funds are pooled by an investment manager in alternative investment fund, what features or what benefits do they demonstrate? So investors are pooled together into a common corpus that would be managed by an investment manager. This is what precisely happens in case of investment management by alternative investment fund managers. It helps to bring in economies of scale in investment management by combining individual corpuses into a large common fund. Well, that's also true. The risk-taking capability is also enhanced to bring in the possibility of better returns to common fund that would be enjoyed by all individual investors participating in it. So if you see technically and conceptually also, this option, the second option and the third option, all are the features or the benefits. So the answer would be 1, 2 and 3. So all three are basically correct feature or benefits here. Let us move to question 3. Pooling should also satisfy the principle of tax neutrality. What is tax neutrality? What does it mean? See, when you invest as an individual, you get certain tax benefits, right? Like capital gains tax benefit, correct? Just as an example. But when the funds are pooled, what is important is that the same tax benefit should be continued here. Otherwise, if there is a disadvantage in terms of taxation in the pooled fund, investors will not like to be part of pooled fund. So tax neutrality basically talks about that aspect, right? So definitely there has to be a tax neutrality, and that's why the answer is true. Let us move to question 4. Which of the following are a set of rules to ensure that assessees, do not resort to tax avoidance, evasion by setting up complicated structures and practices that do not have any genuine business purpose, right? So we have many regulations as far as the investments are concerned. Even FATCA is a regulation, but this is something to do with how the US funds are being invested by US persons outside US, right? So FATCA is an extraterritorial regulation, but that will not be applicable here. So that's not the answer, correct answer. So I would rather cross it to say that this is not the answer, right? So CRS is also a reporting format or a structure. What is correct here is the GAR. So GAR is what is a set of rules which is created in India, which is Indian regulation, to ensure that assessees do not resort to tax avoidance. This takes us to question number 5. Which of the following categories of companies is buyout possible? So can the buyout be done only in the established cash flow companies, growth oriented companies, or early stage companies, or can it be done in only selected companies, say early stage and established cash cow? Well, that's not correct. It can actually be done in all the three. So here the answer is both, or rather 1, 2 and 3, not both, or 1, 2 and 3. So early stage company also you can do, established companies and cash cow companies also you can do, right? So which of the following is not a type of buyout? So we have many types of buyouts which are there. Leverage buyout is there, management buyout is there. But the question is initial public offer and management buy-in, right? So the word buy-in should not be confused to be the incorrect option. Buy-in is also a kind of a buyout, right? So the answer is initial public offer. We will have a question related to buy-in later which will make this clearer. So just hold on till then. But initial public offer is not a buyout. It's more like offering shares to investors, prospective investors who can invest in companies either through what is called as new share offering or through stake sale or offer for sale. We move on to question number 7, but prior to that I just want to reiterate that the answer here is initial public offer. Question number 7 is, in this type of buyout, the incumbent management of a company seeks to combine with private equity investors to buy a controlling stake in the company. What kind of buyout is this? Okay, is it a leverage buyout? Is it a management buyout? Is it a management buy-in, or is it both buy-in and buyout? What should we put it as? Well, the answer is simple. This is precisely what we call as management buyout. So if you understand this concept, you will be able to answer other questions also related to buyout in terms of distinguishing them from other types of buyout. Question number 8 deals with dash 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 is the purchase of a business by incoming management team. Now buyout was the existing management team, but the buy-in is from the incoming management team. So the answer for this will be B. So now I hope you understand the difference. Buyout by the existing or the incumbent management, buy-in by the incoming management. Let us go to the next question, which is dash 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 is the trust where the share of each beneficiary is clearly demarcated. What is that structure? So it's not revocable or irrevocable. It's simple. It's determinate. Determinate structure defines the share of each beneficiary. And the last question also here is related to the same structure, which is trust. Which of the following types of trust structure is allowed as per Indian Trust Acts? Okay, well, revocable and irrevocable is permitted. Public and private are permitted. Determinate and indeterminate are also permitted. We just had a question about determinate. So again, the answer would be 1, 2, 3. I hope you had some additional information that you could get from this particular video. If that's the case, then I don't think there is anything that prohibits from subscribing to this channel and liking this video. Last but not the least, do not hesitate to share it with your friends also. Thank you. Do comment if you found this to be useful in the comment box. Comment must be kept healthy, and it should be something that will help the creator make the platform better. Thank you so much.